Hello and welcome to Bradstreet CPAs video tax tip of the week series. My name is Lance Bradstreet, and as always, welcome and thank you for joining us. Today's video is coming out in conjunction with our email tax tip of the week series. And in today's email tax tip of the week series, we're talking about required minimum distributions. And if you're the age 70 and a half or older, or you help take care of a loved one's finances who is age 70 and a half or older, this is something you need to be worried about and make sure you have in place. When we're talking about required minimum distributions, we're talking about money that's held in retirement accounts, your 401ks, your 403bs, IRAs, simple SEPs, the whole myriad of retirement products that are out there. Once you hit that age, you have to begin taking money out. And if you're not familiar with this verbiage, if you don't know if 2011's RMD is set up yet, I highly advise you to have a conversation with your financial professional just to make sure it's in place. Any money that's required to be taken out that isn't is taxed at a 50% tax rate. So we can be talking about some serious money here very fast. So again, reach out to your financial professional, have a conversation with them, just to make sure it's in place. A couple other things I want to talk about today that aren't associated with the email coming out. Big one is I'm fielding a lot of questions lately on different types of interest that people are seeing. As the economy changes, so are people's investing habits, and we're having conversations about taxable interest versus non-taxable interest. And taxable interest, we all know it. If you have a savings account or even some checking accounts, definitely your money market accounts and some other investment vehicles all produce taxable interest. And that taxable interest is taxed at your ordinary income tax rate. So if you have an effective tax rate of 17, 27, 35%, whatever it may be, that's what your taxable interest is taxed at. Another type of interest is the interest that you earn on U.S. obligations. And U.S. obligations would include treasury bonds. And a lot of treasury bonds, they're all a little bit different, but in most cases, the interest that's received from those treasury bonds is actually not taxable on your state tax return. So if you live in a state or you're filing a state tax return, that might be a tax advantage for you. A third type of interest is the interest that is produced from municipal bond investments. And municipal bonds, the interest that is produced from them is non-taxable on a federal tax return. This could be a big tax savings. If you set it up even further in depth and you invest in a municipal project bond that is in your home state, then that interest could potentially be non-taxable on your state return as well as your federal. So a good example of that would be, I live in the state of Ohio. If I invest in a municipal bond that was derived from the state of Ohio, I could potentially have tax-free interest income on both my federal and state tax return. All good news for everybody. As these things continue to change and as tax laws continue to change, we're going to bring you updates as they happen. As always, if you have any questions, as I mentioned in the top, we'd love to hear from you in the comments section. Our website is bradstreetcpas.com, and my email address, if anything comes up that you don't want to talk about in a public forum, is lanceb@bradstreetcpas.com. Hope to hear from you soon. Thank you. Bye.